Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing podcast. CMQ investors, welcome to the show. It's great to have you here. What you are about to listen to is the made-for-podcast version of an Instagram live broadcast that was originally recorded on October 1st, 2021. We discussed the Evergrande crisis, Alibaba, Ethereum, Isaac Newton, PayPal, Coinbase, Charlie Munger's timeless wisdom, CHWY, the unrecognized similarities between Jack Bogle and Warren Buffett's investment philosophies, and why Jack Bogle is a personal hero of mine. If you're not already following the podcast on Apple Podcasts or Spotify, make sure you go ahead and do that, and that way you'll never miss a new episode. Also, please leave a review, leave a 5-star rating, and let people know about Compound Money Quietly on social media, in person, however you need to do it. But before you do any of that, I just want you to enjoy this episode. So let's get right to it. Life of Danny G says thoughts on Alibaba and Evergrande situation. Evergrande is how I'm jokingly calling it, like it's a new menu item at Taco Bell. The new Evergrande. Buy it now and lose your money later. My takeaway, if there is one, is two things. Is one, there's always going to be situations like that. As long-term investors, we are going to have to get used to world events shaking things up and making us a little uncomfortable. I think there will always be situations like that. It's human nature. At the end of the day, human nature doesn't mean it makes me happy or it makes me cool, calm, and collected about it. But I think as long-term investors, my best advice is just just keep on keeping on. There's nothing you can really do about it. What can we control as investors, right? Like that's out of our control. What is in our control? The amount of time that we invest, how long we consistently contribute to whatever it is we're investing in. We can control the cost to invest. Are you paying high expense ratios? Are you paying high fees? Are you doing lots of buying and selling and incurring a lot of different transactional costs, taxes, short-term capital gains taxes? You can control that. And you can also control what you put your money into. So if you're buying businesses that you believe are strong, have a bright future, and you've done the hard work to be able to say that, and at least tell yourself that with certainty, not with certainty rather, but have some sort of confidence in the future on that prediction. Sorry, I can't talk right now, which is great for a podcast. But the Evergrande situations, anything like that, you can't control it. So I think the best thing is to get a better understanding of your own psychology and see how much it affects you. Now with Alibaba, that affected me directly. So I bought Alibaba shares, and I had to look this up the other day. I wasn't sure. I think it was 2018. I bought Alibaba, so I'm down since buying it, but it's a long-term hold, and I don't have a lot of individual stocks right now. That one is a short-term loser, but I'm not worried. I'm trying to hold it for as long as possible. But again, I bought it with a long-term thesis in mind. That I did not buy it because Charlie Munger bought it. He recently, I think through the Daily Journal, they bought a lot of Alibaba. But if you know Charlie Munger's investment style, I guarantee you he doesn't really care about the drop right now. It doesn't affect him. And I'm sure the thesis behind the purchase is sound, and doesn't mean it will always be right, because there are things out of our control that, regardless of how good our process was, the results might not reflect that. But at the end of the day, Charlie Munger is the epitome of a long-term investor. I posted this clip of him saying, he bought his shares of Berkshire Hathaway for $16. He said he just sat for 50 years and it worked out really well. And in those 50 years, the price of Berkshire dropped 50%, I think 2 or 3 times. That's the kind of investor I want to be, because I've discovered that's how the real money is made. It's harder to do it that way, but that's the most certain way to really accumulate and build meaningful wealth. But it's harder to do, just like anything would be. It's not supposed to be easy. What are your thoughts on Ethereum? Asked David2588. I've owned Ethereum since 2016 or early 2017. I still own some. I sold, I'd say 80% of it. I just felt like I was getting greedy at that point. So I sold and I kept, about 20% of it. But I've, of course, had that moment where I've seen it go up. I think it's doubled since then. I think Ethereum and what's happening behind the scenes with Ethereum is really interesting. I know some people that are, building things, if it's with Ethereum or on Ethereum. I forget how to actually say that. As far as an investment, it's a speculative asset, right? It's like you buy it because you think you can sell it to someone else for more. And that's just being honest. It doesn't mean it's a bad thing. It just, that's the kind of thing I'm not looking to build a portfolio of. And in general, I think, especially when you've had just some good luck with like some gambles like that, I've become, the more I've learned about investing, the more I'm keen to stay away from stuff like that, because I realized that I was just lucky. If someone's able to make a ton of money on Ethereum in the next year, good for them. I'm cheering for you. I'm just at a point where I was like, I don't want to be greedy, and there's other things that I could do with this capital that I understand and that that I think are sensible. And that's where I am in my own journey. I'm not looking to get any quick bucks. I'm looking to, continue refining my compounding machine. That's how I look at my investment approach right now. And I think it's the most, sensible one for me, but I think in general, it just makes the most sense. I mean, there's just a lot of ways to mess up. And when you mess up, that's how you interrupt the compounding process. So I'm just trying to avoid stupidity. And being that I am a human being who makes mistakes, it's not as easy as it sounds, but that's, I think, the smartest approach for an individual investor is just try to avoid the big mistakes. I think about Isaac Newton when I think about Ethereum, because I've wanted to get back in. I've had those moments where I'm like, oh, I should, this is going to keep going up. And I've said, what would those X number of Ethereum be worth now had I not sold them? But I think back to again, learning history has helped me a lot. Isaac Newton had that same feeling, and he lost a third of his net worth. It pays to learn vicariously through the mistakes of others. That's something I've taken from Charlie Munger and Warren Buffett, and I've taken that really seriously, and it's helped me a lot. The reason I'm so passionate about this stuff is because it's worked for me so well. I'm one of those people that I don't just learn things to learn things. I learn things to try to use them and like for practical reasons. And for me, everything that I've learned from Charlie Munger, or even if it's not directly from him, if I followed he recommended this book and I'll learn something in that book, it's always worked. It's worked really well. I've not had anything that he said to do not work well for me. Good morning from India. Well, good evening from New York City. Ahmed says, what do you think of investing in crypto indirect, like buying PayPal or Coinbase or Robinhood? That's not an approach I would personally take, but I would just look at those businesses, and I would prefer one of those businesses that's not so dependent on crypto, like where crypto is just one. I think PayPal is more interesting. I've not looked at their 10K recently, so I'm not saying it's a good stock to buy. But PayPal is not solely dependent on it, but crypto could could increase earnings potentially, and I don't know about the business. Robinhood, I would stay away from, like you'd stay away from somebody who has, a breakthrough case of COVID, because Robinhood's whole business could crumble if there's regulation on payment for order flow. And I'm not saying that to be controversial. As far as Coinbase, that's another one I don't think they have a competitive advantage. And I don't think that, based on what I think is going to happen in the crypto space, at least in the next 5 years, I wouldn't want to own Coinbase because that's going to hurt their business. But interesting question. I think that's a really cool question, and I'm glad you asked it. All right, let's see what else we have here. Pasha Reiger says, it would be cool if you do a podcast on how to read a 10K and do a live breakdown of one. Yeah, it's a great idea, man. That's a good idea. Thank you for that. I'm going to screenshot this so I don't forget it. NJ Phone Shop says, I think companies like CHWY are going to be on the upswing since millennials rather get a puppy than have a baby. What are your thoughts? I have mentioned before, I made a lot of money in CHWY. I think I doubled my money, and I had a really, I wrote out a whole thesis for myself, actually. I recently sold all my long-term positions because, again, it did so much better than I think I deserve to do. And I feel like it's going to have, just reversion to the mean. And I'm just trying to shift more into a passive indexing approach. And that just seemed like a smart area to take some profits. The only thing that makes me, I think for reasons though, I don't know that stat about millennials would rather have a puppy than have a baby. But I do agree that in terms of they have a very large addressable market. It's a space that is, I think, lagging behind in other e-commerce categories as far as the, pet supplies, let's call it that. That's one of the last categories to go from physical to digital. I can say as a pet owner myself, when I found out about CHWY, my local pet store lost my business just because it didn't make sense anymore. I've had a great experience, which I'm not saying you never buy a company because you have a good experience, or at least not that alone. I think they have very strong management. I think the economics of the business, they make sense to me. It's a space that I understand. I'm not so sure about the price right now. I think it might be a little overpriced because there's a little bit of exuberance baked in, but I could be wrong about that as well. But I do think CHWY is a company that has an interesting, there's a lot of models I could plug into that. You could say, well, what about Amazon, right? Like, couldn't Amazon just come take all their money? Couldn't Amazon decide, hey, we're going to do Amazon Pets? But there's a lot of examples from, you could do like ecology or biology of the advantages, or at least the potential to have advantages when you specialize. Like specialization you can carve out your own niche. I think Chewy's done a really good job of being a focused brand in that regard. If you're thinking, hey, I need to get something for my dog online, Chewy comes to mind first. At least it does for a lot of consumers. And I think there's just there's a lot of forces behind it. I think there could be a bit of the right kind of elemental forces are behind that company, and I think that's a good reason. But price-wise, I'm not so sure. I mean, I think it's a little inflated right now, but that's and I also worry that there is, because of the founder of the company being in some ways like one of the leaders of the meme stock kind of crowd. I think that crowd is going to be the first to jump out of stocks when they start, reverting to the mean, and I think that gives me pause, because I don't want to be, I think some of those prices could go up and go, whew. Doesn't mean they're not going to come back, but I'm just saying, I know for myself as an investor over the years, when I thought I really knew something and then I experienced a correction and I realized, I have not mastered my psychology yet. Until that happens, I think this new wave of investors, which I am all for, like I'm only like one generation ahead of them, when I think of in terms of when I started investing like seriously. But I think that's an area where stocks have been on up and up and up and up and up and up. And so you haven't had those moments where you're like, oh, can I stomach this? And it worries me that they've piled into Chewy because of the connection to, what's his name? Ryan something. I love, I'm like such a big shot. I'm like, what's his name? The guy that sold his company for $100 billion. Chewy founder. What's his name though? His name is, drum roll, Ryan Cohen. Ryan Cohen and Michael Day. Okay, I'm just scrolling through here. Hello, everybody. I'm going to wave back to people. And I've got to jump here in a second because I'm going to record some new episodes. I'm doing one on John Bogle. Do you guys know about Jack Bogle? Anyone, if you're listening, like actively hit that heart button. Let me see if anyone's actually with us. Leor says, love Jack Bogle. Yeah, me too, man. Jack Bogle's come up in 4 of the episodes. But when I look at Jack Bogle's life and what he did and what he stood for, I just admire him. And the reason is this. I went back to his thesis that he wrote at Princeton in 1951. His big thing was not about it wasn't like going against Wall Street. He was saying, hey, this investment business could be a more win-win situation for a win for the business, but also a win for the investor, for the customer. And he was just really principled. And so, but when he made Vanguard, and that was, people mocked him. They said he was, this is a sure way to get mediocrity. And, it's, they called it like Bogle's folly and all these different things. But he kept on going, and he was just a champion for the individual investor. And I think as someone who considers himself an individual investor, I really appreciate what he did, because if you think about this, there were $10 trillion, I think, in indexes like within the last year. I think that was which is a huge number, by the way. And so let's say if you were paying the average investor, the individual investor as a whole, like our group of investors were paying 1% of that, right? 1% of, what did I say, 10 trillion? It's a very large sum. Whereas with Vanguard, with their expense ratios being as low as they are, the ones that I own are no more than 0.04%. Think how much money that saves per year for the individual investor. And so Jack Bogle could have taken that money for himself and even given himself more of I think when he died, and would never talk about someone's net worth if it wasn't just public, but I think he had $80 million, which, hey, he wasn't wanting for much, but this is somebody who could have, just loaded his pockets up. And that's what's been typical in certain industries, right? Like he created a lot of value for people. Those fees could have been higher and still have been a great deal for the individual investor. And he could have, been a multi-billionaire. But he was really principled. He wanted to make investing in those funds as low cost as possible, because those expense ratios we pay, that's paying for the overhead. That's paying for the marketing. Most funds, and we've talked about this in some other episodes, but I continue to talk about it because it's interesting to me, is, anytime you see a commercial for the QQQ, that's overhead costs, right? Like that's why you pay a fee. So Bogle's thing was he didn't like to see all the marketing in investment, because his thing was, he didn't say this exactly, but I've told so many people about Vanguard index funds, and I've never been paid a dime, never expected to be paid a dime, but because they're an awesome product, and as human beings, we like to show other people things that make us look good. if something's really great, like it's going to spread. And that's something that you've seen with the Vanguard funds and Vanguard in general. I mean, we're talking about Jack Bogle right now, not because I saw a commercial for it or for him or for Vanguard, but because of what they do for me as a customer. And so when you have these funds that have to spend all this marketing money, not because you in many cases you have to spend money on marketing to get noticed. That's inevitable, and I know that better than anybody. But at the same time, how much is enough? Should you have to keep pouring more and more money into do like just basically promote it like it's a consumer product? And that's how these funds market themselves now, because they want to have as much inflows as possible, because that's what the fees charged against. Kathy Wood is an example, 0.75% to get into any of her funds. It's a nice business model to have. And so you see Kathy Wood everywhere, and again, not knocking it, but it's just the reality. So I look at Jack Bogle and just what he stood for, and how even when he left Vanguard, when he retired, he actually criticized Vanguard after he was away from Vanguard. Like, talk about principles. And I just really respect it. Like, I respect truth tellers. And if you read his stuff too, he reasoned from evidence. All his papers that I've read, they're just loaded with stats, data. When I look at him and Buffett and the differences and similarities, people might say, well, Warren Buffett's the greatest stock picker, or one of the greatest stock pickers ever. Why would him and Jack Bogle even have anything in common? Why would he recommend passive indexing? So they both looked at investment the same way. You're buying businesses. They were looking at the playing field and seeing it as it really was. Secondly, Buffett's approach for individual investing, for individual stock investing, would be, concentrate on a handful of different names, load up on them, and ride out through the good and the bad times, and let your money compound as aggressively as possible over as long a time period as possible. Rather, Bogle's thing was just buy one or two different funds and do the exact same thing. So it's just the difference of saying, okay, trying to beat the market versus trying to get the market. Buffett today will say, and the stats will show this, it's very difficult for even professional investors to beat the market over any long time period. That's just the data. And we know as long-term investors, our biggest advantage is time and compound interest. Even the investors who are indexing, if you're doing it through an advisor or something like that, you're not getting the full market rate of return that as Bogle would say, you're entitled to get, because you're paying all these fees, and there's all these ticky-tacky ways that we end up, having our returns eroded. I'm going to stop us here because our very next episode is going to be all about Jack Bogle, and one of the most important lessons that I've learned from Jack Bogle that's helped me immensely as an investor. Charlie Munger always says, the best thing a human being can do is help another human being know more. If you learned something from this episode, share it with a friend, post it on social media. It goes a long way, and I appreciate it a lot. This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.